Chapter 7 deals with index funds, or index investing, technically. But index investing is basically passive, investing in passively managed funds. And the Bogleheads are very interested in investing in index funds because over the long run, and this might be a decade or longer, but over the long run, passively managed funds outperform about 90% of actively managed funds. It is difficult to outperform an index consistently, time after time after time. I mean, sometimes, some years, you might beat the market, is what they call it, but in other years, you probably won't. And so, if you don't consistently beat the market time after time, and you don't beat the market by enough to overcome the fees that you charge your investors, it's not really worth it for investors to choose your actively managed funds. So they opt for passively managed funds, and we have seen investors flock toward passively managed funds over the years. They've become quite popular. Now, the book reports some data. It's a little bit old, but I'll update it with some more stuff later. But over this particular time period, the Standard & Poor's 500, which again is a measure of the broad U.S. market for equities, it earned about 12.2% annually. But mutual fund investors only earned about 8.8% annually. Why didn't they earn the same amount? The reason they didn't is because many of them were trying to time the market. By timing the market, I mean they want to be in the stock market when it's doing well, and they want to be out of the market investing in, let's say, treasury securities whenever the market is not doing well. So if the market's going to lose money, they it, let me phrase it this way: if they think the market is going to lose money, they sell their equities, they buy treasury securities so they can earn a low but positive return at a time when the market is dropping. Once they think the drop in the market is over, they'll buy back into the market and ride the upswing while the market is rising. It is difficult to time the market, but people try it. And most of them don't succeed. That's why this passive investment in the S&P 500 earned 4% almost more than people who were trying to time the market and invest in what they call the top performers. I still haven't gotten the hang of typing and thinking at the same time. Um, we also, so we see people trying to time the market. We see people trying to chase the top performers. What I mean by that is every so often, every quarter, every year, various newspapers, magazines, or websites will report which mutual funds perform the best for that particular time period. We see people pouring money into those funds, but they pour money into those funds only after they've been announced as the top performers. Just because they were the top performer that particular time period doesn't mean they're going to do well now after people have poured lots of money into it. And chasing the top performers costs money. If you're in an actively managed fund that has an exit fee, a redemption fee, or a deferred sales load, it costs money to cash out your shares and move that cash into the top performer that you're chasing. And the top performer is probably going to be an actively managed fund, and it may well have a front end load or a sales fee, and so you're going to have to pay that too, in addition to the higher management fees that actively managed funds have. Index funds, by their nature, are less volatile than actively managed funds, so an index fund isn't likely to be a top performer. What it is likely to be, though, is stable and fairly low risk compared to the top performers. And it's very likely that over the long run, it's going to do better than the actively managed funds. And so overall, the stock market is very volatile in the short run, but over the long run, it tends to rise. So, investing in index funds over the long run is going to boost your return, generate positive returns. Over the short run, if you buy and sell actively managed portfolios, you're going to pay all those fees I was talking about, plus the fees are, sorry, the funds returns are going to be quite volatile over that short run. Index investing, they had an interesting header in the book. I'm not sure if it was the title or not, but it said it pays to be lazy. And I normally am not a fan of lazy people necessarily, but what they're getting at when they say that is, first of all, it takes very little knowledge to be an index investor. You need, all you really need is the basic information that this course teaches, and you should be fine. It takes very little skill. I had no skill, but I'll put little skill. What little skill it takes, you'll learn. You've been and are being exposed to it in this course. It takes very little time or effort. And the information that you'll need to research funds is available on Morningstar for free. And then based on that, you'll probably outperform over the long run about 90% of actively managed portfolios over the long run. There are always going to be times when you have a friend or a family member who says, I earned 36% on my portfolio this year that I manage myself, and you only earned 18. Um, but what they're probably not going to talk about are the years or time periods where they lost quite a bit and you didn't lose as much, or you actually earned positive returns during that time period. They're going to brag about their really great years, but they're not going to talk so much about their really bad years. So let me talk about why indexing works. First, index funds don't have load fees. So there won't be a sales load or fee. There won't be a deferred sales fee. I think technically they can have 12B1 fees, but those fees are charged for advertising purposes to try to encourage more people to invest in the fund. And at least with the Vanguard funds, they're quite large. They have billions of dollars in them, and so they don't really need to boost awareness about the fund. So I don't know that Vanguard funds charge 12B1 fees. And I just realized I haven't actually talked about all of that yet. Chapter 9 deals with very specifically with mutual funds fees, so this will make more sense after Chapter 9. They also have low operating expenses. Every mutual fund will charge an operating fee, and it's easier to manage an index fund compared to an actively managed fund. So typically, actively managed funds have much higher fees than index funds. It's easier to manage US based funds versus foreign funds. I looked up, and let me show you where to find this fee. And again, in Chapter 9, I'm going to explain exactly what it means. But if you go to Morningstar.com, and I just typed in the quote, this is for the Vanguard Total Stock Market Index, and this is the main page that you'll end up on when you press enter after you input your quote. Right here, it tells you the fee. This is basically deducted from your return every year. So if a fund earned 10%, then they would deduct 0.17% from your return that year. So you'd only end up with, 9.83% in return that year. So this is an index fund. It invests in US based stocks, and it's diversified across the broad US stock market. It owns about 4,000 different companies. and you can see that it's got a pretty low expense ratio. And it says that it's low right there. I can tell it's low because I know that actively managed funds on average charge an expense ratio over 1%. It's about 1.4%, I believe. So to see a ratio far below even a half a percent is great. I would not invest in a fund that had an expense ratio in excess of 0.5% because I think that's too high. And just for comparison purposes, I've got the Vice X mutual fund. It's an actively managed fund. It is not diversified at all. It does only invest in equities. And you can see the expense ratio is much higher. So if this fund earned a return of 10% in a particular year, after deducting the expense ratio, you would only net about 8 point what 5-6% after paying that fee. You'd net a lot less than you would net from that Vanguard Total Market one I was showing you. ETFs have even lower expenses. I popped up this is the Vanguard Total Stock Market ETF. It actually invests essentially in the same portfolio of securities as the Vanguard Total Stock Market Index Fund, but it has a much lower expense ratio. So ETFs, if you can find a comparable ETF compared to an index fund, it will typically have a lower expense ratio. The problem with an ETF is you can't put small amounts in it. Like if I only have $25 that I'd like to add a month to my Vanguard index fund, I can't do it that way for this ETFs. I have to buy a full share, which would cost right now $104.51. So low operating fees, and I'm just going to say compare Vice X at I think it was 1.47, VTSMX at 0.17%, and then I don't know exactly what the ticker was, but I'll put VT ETF. That was the equivalent exchange traded fund for the VTSMX, and that was 0.5%, I believe. Um, and so this is deducted from your annual return. Just want to get this up on the page a bit. There we go. Index funds are also fairly efficient tax wise. Um, Basically, what happens with an actively managed fund, they are constantly trading. They'll so if I manage the VICEX fund, I'm looking for a company in one of those four industries that they invest in: gambling, tobacco, defense, and I can't think of the other one. But let's say I do my research and I find a gambling company that I think is a really good buy, and I'm the manager of the VICEX fund. I purchase it, and I'm right, and the stock price does really well, and I think it's reached a peak and it's time to sell it. So I would sell the shares in that particular company. That would generate a capital gain for the fund, and taxes have to be paid on those capital gains. So because of turnover again is just buying and selling securities, actively managed funds will probably pay more taxes. And if they distribute the capital gain to the investors in the fund, or if they distribute dividends to the investors in the investors have to pay taxes on those dividends and capital gains, unless the money's invested via a tax deferred account, which I'll talk about in chapters 10 and 11. Passively managed funds have lower, in many cases, much lower turnover. That results in less selling, or less, I'll just say less trading, but it's technically less selling of shares of stock. So even though they might have a stock that's increased in price, they won't actually sell it. The paying of taxes on a capital gain doesn't occur until you actually sell the stock. So if I have a stock in my portfolio that I still own and I've never sold it and it's tripled in price, I don't have to worry about paying the taxes on that tripling of the price until I actually sell the security. And since actively managed funds sell securities far more often than passively managed ones, then active managed funds will pay more in taxes or pass those capital gains and dividends along to you more often so that you'll have to pay more in taxes. You should, after this class, be able to look at some mutual funds offered by, let's say, Vanguard or Charles Schwab or, oh gosh, I'm BlackRock. I couldn't think of another company that had mutual funds, even though there are quite a few. Um, and you should be able to evaluate whether they're index funds, whether their fees are high, whether they have a high expense ratio, whether their turnover is a lot. Do they qualify in terms of all the things that we will have talked about in Finance 216? You don't want high fee funds. You don't want actively managed funds because they're not likely to generate enough return over the long run to beat a passively managed fund. You want a fund that's diversified or a collection of funds that will get you to be very well diversified. You should be able to make that determination all by yourself without paying a financial advisor. My ex brother in law does his own trading and he purchases shares of individual securities. He doesn't trade mutual funds. And we had a long talk about that this past summer. And he actually told me that even though he chooses his own investments and prefers to do it that way, he pays a financial advisor to, quote, keep him from doing something stupid. And he told me that he pays her a 0.5% in a fee every year. That's, I just think, ridiculous. You shouldn't need that once you finish this course. He pays her a fixed percentage of his return every year. Some financial advisors, if you absolutely feel like you need a financial advisor, I wouldn't go to one like he does. I would choose one that just charges you an hourly rate. And so you can bring in paperwork related to your investments, make sure you have like financial goals in mind, and they can work with you on an hourly basis to help you see if you're on the right track. And they charge maybe $250 an hour, but that's, if you only see them for an hour once a year, that's probably going to work out better. And I still don't even think you necessarily will need to see them that often if you pay attention in 216 and you take away from this class working knowledge of all this information. It is also extremely easy to diversify. There are certain funds, particularly target retirement funds, that claim with the purchase of this one single fund, you can be really well diversified. I don't necessarily agree with that. I do think they're trying to accomplish that goal, but they don't accomplish it to my satisfaction. But with the purchase of 4 or 5 different funds, it is incredibly easy to diversify across the US, across foreign countries, across large cap stocks, small cap stocks, um, different types of bonds if you want them in your portfolio. So it is easy and fairly inexpensive. Well, I didn't spell that right. To diversify. I have posted a recording that I made that just analyzes and talks about my daughter's portfolios. They both inherited about $14,000 a few years ago, and they agreed. It's quite loud outside my office, and I apologize, but hopefully you can still hear me okay. But anyway, they agreed to let that money serve as a start to their retirement portfolio, and so I took that money and invested it in index funds, and I've recorded about a 20-minute video that explains how it's diversified. It looks at the fees that they pay. It looks at the different types of assets they're invested in for different countries, different sectors, etc. So you ought to give that a look. Um, just to help gain some practical knowledge. And then, let's see, I'll add a little more to that. Diversification is important. Why? Because it helps reduce your risk. As I mentioned in the video about my daughter's retirement funds, they're invested in four different mutual funds. And across those four different mutual funds, indirectly, they have ownership in 11,000 different securities across the world. So, equity in 11,000 different companies. That reduces the risk. If 10% of those companies go bankrupt, they're still probably going to be okay. 10% might be a little high, but if 100 of those 11,000 companies go bankrupt, that's not a big deal. There'll still be almost 11,000 companies left to be earning a return and growing their investments. So diversification is important. There are plenty of stories of people who I think it was in the early 1990s when Enron happened. Y'all might not be aware of Enron, but it was an energy company that went bankrupt. Turns out they'd been misrepresenting how things were going in the company. And there are a lot of people who worked for Enron and they had all their money invested in Enron stock. Their retirement account was the Enron pension. And when Enron went bankrupt, they didn't have all that anymore. And they lost most, if not all, of their money and their job. So it is to your benefit to diversify. And then lastly, there's little to no consequence as to who manages the fund. In actively managed funds, a lot of people are very interested in who the manager is and how long he's managed that fund. If that particular manager stops or quits working for that fund and goes to work for a different fund, a lot of times investors will follow the manager because they think, hey, this manager has done well for us in the past and we really like that guy. We don't necessarily like the fund. So when he moves to another fund, they follow him. With index funds, it doesn't work that way. Index investing is fairly straightforward, and it doesn't matter if I manage the fund or somebody else manages the fund. So long as we follow the policies, we'll do equally as well, regardless of who the manager is. So if I decide to leave or I retire, it's not going to really hurt the performance of the fund. There are some issues, though. One is what's called, well, actually, it's not really an issue, and I think I'm going to pop it here. There's something to be aware of. It's called style drift. And to explain that, I'm going to pop over to ViceX and I'm going to look at the portfolio. Morningstar has what they call a style box. This this is the style box right now for Morningstar. What this means is 59% of ViceX is stocks are invested in large cap blend companies, 9% in large cap value, 4% in small cap growth, 1% in small cap value. The darkest cell in this style box is where the bulk of their assets lie. Down here, they track the style over the last few years. You can see that the style has shifted. It used to, back in 2011, be large cap growth. Then it switched to large cap blend. Then it switched back to large cap growth. Then back to large cap blend again for the last couple of years. A an index fund isn't likely to have that issue. And like with a small cap fund, if you invest in a small cap fund that does really well, those small caps are going to grow and their prices are going to rise, which is going to make them become probably mid caps and maybe even large caps. So, what a manager will tend to do is sell those as they do really well and find more small caps to invest in, but they might not do that very quickly. So, you could see, for instance, a small cap fund have more style drift than a large cap fund, unless the market crashes, at which point large caps could become mid caps. This isn't as likely of an issue with an index fund. Index funds tend to perhaps not be as focused as actively managed funds. Like the VICEX fund is very specific about which industries it's going to invest in. A small cap, actively managed, aggressive growth fund, let's say, would be perhaps more focused than a broad small cap fund. And then this one I do want to put as an issue, and that's tracking error. And that's just best explained. So I'm going to pop over to, I keep going to the wrong one. I want to go to the Vanguard Totals. Actually, I don't want to use that one. I'm going to use the Vanguard 500 Index Fund. So the VFINX. I would choose the noisiest day to record this video. This Vanguard 500 Index Fund is designed to track the Standard & Poor's 500. And what I want to do is see how well it tracks it. The let's see. This is for the past decade, this particular graph. And the index fund is in blue, the S&P 500 is in green. And you can see, like over here, there's not really any blue showing. Up here, there's a tiny bit of blue showing, but that basically means the blue and the green lines are overlapping each other for the most part, which means that the Vanguard 500 does an excellent job tracking the S&P 500. Down here, I can see, actually, let me go to more. Hopefully what that will do is expand it to a decade. That's, well, it gets me here, which is good enough. So here are the returns for the past decade for the Vanguard 500 and the S&P 500. And you can see that for most of the time the Vanguard 500 does a little bit worse than the S&P 500. But for the most part they're right or very, very close together. This row, and hopefully the blue shading is showing up as I'm moving my cursor, but this row right here is the tracking error. So in 2005, the Vanguard 500 earned 0.14% less than the S&P 500. In 2009, it earned 0.02% more. For the most part, well, I said that already. This difference is due to the fact that the fund's expense ratio is deducted from this row up here, and their expense ratio is about 0.17%. So deducting that gives us these returns, which will result in returns that are ever so slightly less than the S&P 500, ever so slightly by about 0.17% if I were to average this blue row. But that's what's causing the tracking error for the Vanguard 500. This is one of the best funds in terms of perfectly tracking almost the S&P 500, because this particular fund actually owns all 500 companies in the S&P 500. So you expect it to do a great job. It doesn't own them in exactly the same weighting scheme. And so let's see. Here are the sector weightings for the S&P 500. They're this benchmark column. Here is the weighting for each sector for the actual fund itself. So you can see, let's go with the technology sector. The Vanguard 500 has 18.37% of its stocks invested, or money invested in stocks from the technology sector, whereas the S&P 500 only has 17.63. So you can see the Vanguard 500's a bit overweighted in this technology sector than the S&P 500. It's overweighted in this one and this one and this one. It's got to be underweighted in something. It's underweighted in industrials. It's underweighted a fair amount in real estate. But because it's not perfectly weighted in across the sectors as the S&P 500, which is the benchmark, that's also causing some of the tracking error. So it's due to perhaps different weighting schemes and the expense ratio. And it could also be due to, but not for the not for the Vanguard 500 because it doesn't do this. It could be due to investing only in a subset of the securities in the index. But again, the Vanguard 500 doesn't work that way. It owns all 500 of the S&P 500 simply because it's gotten so big over the years. It has enough money to do that. Now, I want to also talk a bit about, or just perhaps summarize the things that I've mentioned already, index ETFs. I showed you the Vanguard Total Stock Market ETF. And again, ETF stands for Exchange Traded Funds. You can buy them through your stockbroker, but if you have an account like with Vanguard, I believe you can buy their ETFs directly through Vanguard and not through a stockbroker. Typically, if you buy them through a stockbroker, you have to pay a commission. So I'm going to do the disadvantages. I'm going to try to write the word disadvantages. You generally need a brokerage account. So if I wanted to buy 15 different ETFs, that would be a lot. But if I did, and each ETF was like one was owned by Vanguard, another by BlackRock, and there are some that aren't owned by investment companies, they're created by the exchanges, and you can't buy them, you must buy them through a broker. So it's may be easier for me to open one single brokerage account and manage all those purchases through that. If I buy them through a broker, I generally must pay a commission when I make a trade. So if I want to add $100 a month to my ETF, I have to pay my broker $10 a month. That's what kind of commission he charges me. And that's an expensive commission on $100 investment. So I wouldn't be likely to do that. Instead, I would invest my money in a mutual fund rather than an ETF. But if I inherited a decent amount of money and I wanted to plow it into the Vanguard total stock market, I would probably just purchase an ETF because on a large sum of money, that lower fee that ETF charges is going to help me. But so even though I generally must pay a commission when I purchase ETFs through a stockbroker, some brokerages have a small selection of ETFs that are commission fee free, offer commission free ETFs. So I can buy those ETFs without paying a commission. I use Ameritrade as my broker. I'm not necessarily saying it's a great broker, it's fine, but I believe they have 100 ETFs and there are thousands of them. So 100 might seem like a lot, but it's a relatively small amount given the whole universe of ETFs. They have 100 ETFs that they offer that you do not have to pay a commission on, which is nice. Let's see. And you cannot buy a fraction of a share of an ETF. So again, if I only have $100 to spend and I want to buy an ETF that costs $200, I can't because I don't have enough money to do it. The nice advantage, let's see. At the moment I can only think of one. The annual fees are lower than even index mutual funds. So for instance, the Vanguard Total Stock Market mutual fund had an annual fee of I think 0.17%, but the corresponding ETF for that index fund had an annual fee of only I believe 0.05%. So that's a pretty big difference. The problem is you can't necessarily find a corresponding ETF for every type of index mutual fund out there. So you might be forced to buy a mutual fund simply because you can't find an ETF that meets your requirements. And there's some other advantages, but they relate more to if you're investing quite a lot of money, which most of you probably wouldn't be. So I'm not going to cover that. Most, by far, most ETFs are passively managed. And when I say most, there are a few thousand ETFs. There's only probably about a dozen that are actively managed. That might change over time, but the whole goal behind those ETFs was to create passively managed securities that you could trade throughout the trading day. And remember when I talked about ETFs, that's why they were developed, because people wanted to buy and sell shares of their mutual fund before the trading day was over, and mutual funds don't actually work that way. They wait until the trading day closes to figure out what price you're going to pay or receive. ETFs, you can trade throughout the trading day. So at any rate, most of them are passively managed, low fees. The Boglehead book says doesn't seem to like ETFs that much. I think there are good reasons to trade an ETF, especially if you're. No, I wouldn't go the ETF route if I didn't have a whole lot of money to invest in a particular month. So if I wanted to add small amounts to my investments on a regular basis, I wouldn't do that through an ETF. But if you have a decent amount of money, I would certainly be willing to trade through a brokerage account, especially those commission free ones. Because the commission isn't that large, it's $10 for one single transaction. And if it's a large dollar value transaction, then $10 isn't that big of a deal.